Buongiorno a tutti, intanto benvenuti.
Good afternoon and welcome. Welcome to all of you.
Mi presento, sono Michele Cervone,
My name is
molti
Michele
di voi già
Cervone.
hanno avuto
I know
maniera
many of
in
you
passato
had
di
the
incrociarmi,
chance
incontrarmi.
of meeting up with me.
L'argomento all'ordine
Well,
del giorno, investimenti
the topic of
orientati al
today,
reddito per investitori
income-driven
prudenti.
investments
Perché questo
for
titolo? I motivi
cautious
principalmente sono due.
investors.
Il primo
There's two reasons
motivo
for this.
è
The first
che
reason
abbiamo visto in questi
is
ultimi
that we
anni
have seen in the
un
past
fortissimo
few
orientamento ai fondi a
years
cedola,
very
tant'è che le statistiche ci dicono che oggi in
coupon-driven
Italia
attitude.
più del
In
50%
Italy,
dei
over
fondi
50% of
venduti
the
sono
funds
fondi con
being
cedola.
sold are coupon
Nello stesso
based.
tempo noi abbiamo
But at the same
abbiamo
time,
quello che è il fondo a cedola più
we have
conosciuto
the most
probabilmente in
well-known and
Italia, quello con
popular
le masse
coupon fund, the one that
maggiori,
has
che è il Global
the
Income Fund,
highest
che è un
amount
fondo che è stato
of
sostanzialmente il primo sul
masses, the
mercato
Global
in
Income
realtà ad
Fund.
essere funzionale a chi volesse una cedola. Non è il primo a essere nato, ma il primo sul nostro mercato a essere stato venduto come tale. È un fondo che in Italia ha circa 7 miliardi di asset, quindi un fondo estremamente importante di cui molti di voi conoscono la storia, hanno visto in questi 8 anni e mezzo in tanti mercati differenti come il fondo ha agito e ha reagito e ha sostenuto, è una storia di eccellenza. E date queste premesse, visto che nello stesso tempo abbiamo visto in questi ultimi anni, e probabilmente lo vedremo ancora di più nei prossimi, il cliente tradizionalmente cauto, quello che era abituato ai nostri titoli di Stato con certi rendimenti tanti anni fa, un po' spaesato di fronte al fatto che dall'obbligazionario è stato per certi versi costretto a passare ai fondi income, quindi portando con sé un livello di rischio che magari non gli era consono propriamente, perché è passato da un rischio tendenzialmente estremamente conservativo a un rischio più di tipo bilanciato, perché tutti i fondi income tendenzialmente hanno un rischio molto simile a quello dei fondi bilanciati. Abbiamo ritenuto doveroso, date tutte queste premesse, il team che si occupa di del Global Income ha ritenuto doveroso costruire un nuovo comparto che fosse lo scalino di mezzo, un po' il fratello minore del Global Income, quindi un fondo income esattamente con le stesse prerogative del suo fratello maggiore, cioè del Global Income Fund, ma un fondo di tipo conservativo che avesse un livello di rischio decisamente più consono al cliente prudente rispetto agli altri fondi che sono presenti sul mercato. Quindi una storia di successo alle spalle, è il fratello minore che arriva 6 mesi fa sul mercato, è stato autorizzato circa, credo nel mese di ottobre, quindi sono praticamente 6 mesi che è stato lanciato e negli ultimi mesi è stato sostanzialmente anagrafato da quasi tutte le realtà con le quali noi abbiamo possibilità di distribuire i nostri comparti. In questa disamina io mi avvarrò, faccio solo l'introduzione, poi riprenderò la parola solo nella parte finale, mi avvarrò di due colleghi. Da un lato ho qui di fronte a me, invito subito sul palco Natalia Bucci, che è una collega che arriva da Londra, ma il nome tradisce origini assolutamente, anzi è mia corregionale, origini pugliesi, neanche italiane direi, che però lavora da tanti anni all'estero per noi ed è gestore del nostro Global Convertible Fund. Lei è uno dei gestori del Convertible Fund e insieme a lei avremo tra un istante, vedremo in collegamento da New York Michael Schonaut. Michael Schonaut è il responsabile del team che gestisce il Global Income Fund da New York. Considerate che il nostro Global Income è un fondo realmente globale perché il team di gestione, il team che fa asset allocation è a New York, però in realtà le varie sleeves, cioè le varie parti di cui il fondo è composto, sono gestite in diverse parti del mondo e Natalia è a Londra a gestire, per questo l'abbiamo invitata qui. Lei gestisce la parte dei convertibili che poi impattano e sono all'interno del Global Income Fund. Quindi ci avverremo della collaborazione di Natalia in collegamento diretto con Michael Schonaut per cercare di sviscerare qualcosa in più del contesto dei fondi income, del perché abbiamo creato questo comparto, di come funziona questo comparto, di quelle che possono essere le aspettative rispetto a tutto questo, e nell'ultima parte chiaramente saremo disponibilissimi a domande che verranno direttamente da voi, nel caso ci saranno, ci auguriamo lo siano. Quindi io vi ringrazio intanto di essere, la sala non è grande ma è completamente piena, anzi gente in piedi anche, e ci fa piacere, scusate per quelli in piedi, non ci fa piacere per loro. Lascio subito la parola a Natalia e ci risentiamo nell'ultima parte. Prego Natalia.
Grazie Michele. Buon pomeriggio a tutti e grazie di essere venuti, di essere qui con noi questo pomeriggio. Buongiorno Mike.
Good morning, Mike. That's morning, right? Yeah.
Yes, good morning here.
Good morning
Good
to you.
afternoon to you guys.
Yeah.
Volevo innanzitutto ringraziarti per
First of all,
essere qui
thank you
con
very
noi,
much for
questo
being with
evento,
us, for
anche se ti
joining
abbiamo
us in
solo
this
in maniera
event. Thank you.
virtuale
Although
oggi
we
pomeriggio.
can only have...
Come ha anticipato Michele, il tema di questa sessione è il Global Conservative Income Fund. Avremo questo formato di un'intervista, farò delle domande a Mike, con delle risposte da Mike, e poi alla fine, alla conclusione dell'evento, un Q&A dal pubblico. Mike, mi senti?
Mike, can you hear me well? Yes?
I,
Is that all
I
clear
can.
to you?
Hear you great. Yep.
Wow, thank you.
Comincerei subito con le
Let me start,
domande.
with the
Innanzitutto,
questions. First
la
of
prima
all,
domanda
the
che
first
volevo
question I have for
farti
you,
è
Mike.
questa. Sono tanti anni già dalla fine della crisi finanziaria, dall'inizio delle politiche di quantitative easing che sono state implementate dalla maggior parte delle economie sviluppate a livello globale, che il tema di investire per produrre reddito è un tema centrale per gli investitori. Nel contesto attuale in cui i tassi di interesse stanno crescendo, pensi che il tema di produrre reddito, di investire per produrre reddito, rimarrà un tema centrale, quindi importante nel 2017, 2018 e negli anni a venire?
And thanks everyone for being here today, and thanks to the great technology allowing us to do this over video. It's pretty amazing. But I think it's absolutely clear that income is going to remain a theme well into the future. It's clearly been an area of interest over the past years, and particularly the low interest rate environment, I think, has driven a lot of that interest for income. But I don't think any of these drivers are really going away anytime soon. So obviously, if we look at a picture of what's happened to bond yields over the past 30 years or so, we can see that they have come down dramatically, and post-financial crisis, they've come down even more so. And even with this slight uptick in yields that we've seen, even with the move higher post the US election and even leading into the US election, yields are still very low by these historical standards. So we're not looking at yields that are all of a sudden going to be back.
Scusate, Mike, can you wait a second, please? There is no volume, there is no translation. Non c'è traduzione. No, non c'è. Non arriva l'audio in cuffia. Grazie. Sorry, Mike. 1 second.
Sure.
Hello, Mike, could you please say something?
Mike, can you say
Yes,
something?
Thanks, okay.
Sì, si può ripartire, si sente. Ok. Mike will try to continue. Let's see what he said. Could you start again talking about this slide, interest rates going up? Mike, potresti ricominciare sulla slide, la prima slide?
Can you hear me? Can you hear me, Mike?
Yes.
Could you please go
Yes, I
back
can
to
hear.
the first slide? Okay, thank you. We're ready.
Sure.
Potresti ricominciare dalla prima slide? Stavi
Yes.
parlando
So
dei
what I was
tassi.
saying was that even though yields have moved slightly higher in the recent periods, post the US election, and as we've seen some improved growth globally, by longer-term standards, yields remain still very, very low. And we're unlikely to move back to pre-crisis yields in the short term. So what that means is even if we're starting to talk about moving out of this very low interest rate environment, even if we're starting to talk about the Fed raising rates a few more times, we're still at very low levels. So yields remain low, and traditional sources of income, like government bonds, are still not going to be delivering for the needs of investors. If we look a little more closely at government bonds on the next slide, we can see the tremendous proportion of government bonds across the globe that yield below 1% and even below 0. This means that traditional income investing is still not going to deliver for investors. So we need to think about other ways to deliver that income for our investors. So in a sense, if you think of it, the supply of income still remains pretty low. It still remains pretty challenged. But then we also look at the other side of the picture, the demand for income. So we don't see any signs that the demand for income is going to be lessening. Think about demographics. Think about demographics across the developed world. In virtually all areas across the developed world, we have aging populations, right? Their need for income as they approach or invest for or near retirement is likely to only be increasing and increasing dramatically over time. So investors are going to continue to need income, and the sources of income still remain somewhat limited. The last point is that we think about what our assumptions are for markets, and we create annually a set of long-term capital market assumptions that look at expected returns across asset classes. And what we have seen over the past few years is that the expected nominal returns across a wide range of asset classes continues to come down. And what this means is that yield or income is likely to play an increasing role in the total returns that we can expect over time. So income is still not available in the traditional ways, the traditional low-risk ways, CDs, government bonds that it used to be. The demand for income is likely to be continuing, if not increasing. And income and yield will likely play a greater proportion, a greater role of our overall total returns. So basically what we're saying is this income theme is not going away anytime soon.
Grazie. E come ha accennato Michele, tu e il tuo team gestite un altro fondo che è orientato a reddito, che è il Global Income Fund, con grande successo già dal 2008. Come mai avete deciso di lanciare il Global Conservative Income Fund?
Yeah, it's an excellent question. So we really wanted to leverage what we have learned and what we have delivered in the Global Income Fund and think about how we could apply that for different objectives. So when we look at in places across Europe and Italy in particular, where many investors are in low-risk investments, whether it be cash, government bonds, or even very high-quality government bonds, and not meeting their yield objectives, it would be a fairly substantial risk change to move from those types of portfolios all the way to the Global Income Fund. Now, the Global Income Fund is not a very high-risk portfolio, but it is similar to a traditional balanced portfolio. So we think of its risk profile as similar to a 60% equity, 40% income portfolio. So that is a substantial move from all cash or all fixed income. So what we wanted to do was leverage everything that we've done, the structure, the process, the philosophy of the Global Income Fund, and apply that to a lower risk level, conservative, something that looks more like a 30% equity, 70% fixed income portfolio, still focused on delivering an attractive yield, still focused on managing the risk, and still utilizing the same tools that we're using in the Global Income Fund for delivering this objective. So if you look specifically at what this means for a portfolio, the first is, because the risk level is lower, we need to think very carefully about the risks that we're taking in the portfolio. And the first one that I already mentioned is equity risk. So clearly, we're going to be reducing the equity risk that we have in the portfolio. Equities and REITs, you can see on the chart in front of you, are basically about half the weight. And that can vary over time depending on the market environment. But if you think about our broad ranges, where in the Global Income Fund we can go, let's say, up to 55% in equity plus REITs, you're looking at really something that would only go up to about 40% in equity plus REITs in the Global Income Conservative Fund. Now, this means you're likely to achieve a lower yield. That will be limited by the fact that our credit risk also comes down a little bit in the Global Income Conservative Fund. We want to balance those risks. So as equity risk has come down, we also need to think about how much credit risk we have in the portfolio. So the yield has come down by little under 1%. You can see roughly what they're yielding in the current environment. And we expect that over time, it probably yields 1% to 1.5% less than the Global Income Fund. But that's going to be entirely dependent on the type of environment that we're in. But it is important to note that we are still going to take advantage of all the different opportunities across the portfolio. We're still going to have the same underlying asset class exposures, the same managers who are running sleeves, and we're still going to be looking at that same overall objective. But one other thing I want to highlight before we leave this slide is that as we manage that equity risk and that credit risk, there is a third risk that is quite important. We're going to probably talk about that a little more later, and that is the interest rate risk. And that's something that as you move to a more conservative bond-oriented portfolio can play a larger role in the overall outcome. So we'll talk a little bit more later about how that impacts the overall portfolio.
Grazie, in effetti la mia prossima domanda era proprio su questo punto. Hai appena detto che il Conservative Fund ha un'allocazione nel comparto obbligazionario più alta, che di solito si traduce in maggiore rischio legato ai tassi di interesse che vanno su. Quindi come fate in questo fondo a gestire il rischio legato ai tassi di interesse? Quali strumenti utilizzate per gestire questo rischio?
Yeah, so managing interest rate risk is obviously crucial, and particularly crucial in the conservative fund. So there are multiple tools at our disposal to manage the duration, manage the interest rate risk, and think about how that balances with the rest of the portfolio. The first is using our broad opportunity set. So looking across different types of assets with different duration and interest rate risk profiles to think about what are they delivering for us in yield terms and what risks are they providing. We obviously want some protection from the duration in case we have a growth scare or a risk-off environment. So duration does have some role in the portfolio, but we also need to make sure that when we're looking across these assets, we're picking assets that make sense for our overall objectives, right? You can look at the chart here, and there are different ways to access credit spreads. There are different ways to access yields in the portfolio, right? Emerging market debt, for example, is a way to access some attractive yields, but much more duration or interest rate risk comes with that. On the high yield side, you're getting some of the most attractive yields across the portfolio, and there you're getting it with more of a moderate duration. So the idea of this flexibility to look across the asset class, not just investing in traditional fixed income type portfolios, but looking across a wide range. Now, there are other things that we can do in the portfolio. If we think about opportunistic allocations, they are crucial in helping us think about how we manage overall risk in the portfolio. And what's interesting is managing the interest rate risk isn't just a top-down asset allocation decision we're making, although that is part of it. There is also a bottoms-up component, a security selection component. So as most of you are probably already aware, our structure utilizes specialists across the organization to do the stock picking, bond picking, credit picking across the portfolio. And so we are partnering with these specialists to deliver those objectives in what we call these customized sleeves or sub-portfolios. So one area that I think is worth spending a moment on are preference shares, preferred stocks. This is an opportunistic allocation where we felt this exposure, which is particularly centered in financials in the US, was a really interesting opportunistic exposure for the portfolio. But in a bottoms-up perspective, Jeremy Klein, our portfolio manager, went and looked at that space. And that's a space that has a very popular ETF in the US that goes out there and it delivers these preferreds for retail investors. But when you dig a little deeper and look at how that ETF is allocated, what Jeremy decided to do was nothing like that ETF. That ETF holds what we would call some of the more retail-oriented preferreds, right? And most of these are fixed for life. But there is a big component of preferreds, particularly in the more institutional space, that's what we would call fixed to floating. And we have found these, Jeremy has found these to be much more attractive. And it gives us a very different risk profile, a very different interest rate exposure, and so far has been one of the biggest contributors both to yield, but then also helping us in our yield per unit of risk, and our return per unit of risk. At the same time, another example of an opportunistic allocation are non-agency mortgages. And I know these are not as common outside the US, but I think we've been talking about them for some time now. These non-agency mortgages, which we started investing in right after the financial crisis in 2009, offered a tremendous opportunity because of a massive dislocation in the market if you go back in time. And even though dislocation has come in, and we're now not expecting massive yields or massive returns or gains out of this asset class, what is important is they still provide a very strong diversification benefit to our portfolio. They provide a different type of spread exposure. And if you look at what we show on the screen here, we can look at the non-agency mortgage sleeve, and we use our global income fund because it has a longer history as an example here. But the estimate of performance of this sub-portfolio or sleeve through a period where the 10-year, where interest rates have moved pretty dramatically, shows a stable, pretty stable line. And that's important when we think about, can we get yield? Can we get return from components that aren't all just correlated to the same effects and correlated to the 10-year? And then the third point that I'd like to make is that we can manage duration at the portfolio level. We can and do look at what happens when you put together all of these underlying portfolios. When you look at what our equity managers are buying, what our credit managers are buying, what our fixed income managers are buying, what our REIT managers are buying, and you put it all together, we analyze that to see what are the exposures that are coming through. We stress the portfolio. We look at the impact of a 100 basis point move on a 10-year. We look at stress scenarios in MSCI World. And when we see risks that come out of that asset allocation and that overall manager lineup, we can then use either further asset allocation changes or derivatives to help hedge our portfolio. And it's important to note that we're doing this to hedge a risk. So what we have done over some time is used US 5-year Treasury futures to help manage the duration of the portfolio. And in fact, at times, we also use some US 30-year bond futures as well for the longer end of the curve. But the overall theme is that we will use these to help manage our overall interest rate exposure in the portfolio. We will bring it to a level that we think is appropriate. It doesn't prevent us from investing in long maturity corporate bonds if they're delivering an attractive yield per unit of risk. If we're concerned about the duration, about the interest rate exposure, we will hedge some of that duration and get the true exposure that we're looking to achieve.
Perfetto, grazie. Quindi come dicevi all'inizio, questo portafoglio viene gestito tramite delle scelte di asset allocation che vengono poi gestite dai singoli gestori che fanno parte del fondo e della strategia. Come fate a fare la scelta di asset allocation e essere essere sicuri che ci sia un bilancio, un equilibrio tra la necessità, l'obiettivo di generare reddito e il rischio che poi viene nel momento in cui si cerca di magari conseguire un reddito troppo elevato rispetto a quello che il rischio originale che il portafoglio voleva prendere. Quindi questo, la filosofia che è alla base del modo in cui vengono fatte le scelte di asset allocation del fondo.
This is the crucial question or the crucial comment about our philosophy and how we invest for income. Because that is the exact question that we're constantly asking ourselves when making any decision in the portfolio. How do we balance income with return and with risk? How do we balance income, particularly with the risk that we're taking in the portfolio? That is the constant question we're asking ourselves. So over time, we've built out a philosophy, an approach to investing for income. And these have the kind of the core beliefs that we think about when we invest day in and day out. First of all, and I'm sure you won't be surprised to hear me say this, but risk is integral in how we think about managing the portfolio. Risk is not just something that we measure after the fact and make sure that it fits within some bounds. Risk is not just looking at the historical standard deviation of our returns. Risk is thinking about, through multiple dimensions, how are our investors exposed? What are the challenges that our investors could face? And how do we help mitigate those portfolio risks when we deliver them for investors? One of the first lessons that we learned and now articulate very clearly within our investment process is that because we factor risk in so integrally in the portfolio, we believe that you do not want to try to be the highest yielder. You do not want to set a yield target in advance that you have to meet in different market environments. We do not want to publish a yield level that we feel like we need to hold to. Why? Because all of those things lead you, in our view, to make bad decisions. They lead you to concentrate your portfolio. They lead you to take risks that maybe are not going to be as fully compensated. It might lead you to very expensive areas of the market. So for example, if you tried to be the highest yielder in various market environments over the past few years, it would have probably led you to concentrate your equity risk in things like utilities, consumer staples, energy. It would have led you to concentrate your credit risk in very low quality CCC high yield in order to get the highest yields. Now, of course, there's some periods where that works out reasonably well. But there are other periods, like 2015, where those more expensive asset classes get absolutely crushed in the marketplace. Our view is that it is much more prudent to build a balanced portfolio, to look for attractive, sustainable, and growing yields, not necessarily the highest yield. It allows you to make decisions like not overweighting, not putting all of your eggs into a basket of utilities or consumer staples, particularly when we feel like they have gotten very expensive and don't justify the valuations that they have today. It allows us to, at times, move higher quality in our credit allocation and avoid CCCs and avoid energy, metals, and mining companies that have been at the core of a more binary type of environment, right? Predicting which way the oil prices are going to move. That's not the business that we think most of our income investors want to be in. We don't think most income investors, and particularly more conservative income investors, want to be taking a bet on oil prices, want to be taking a single bet on CCC high yield or on a particular sector. The second key piece of our philosophy is a focus on flexibility and diversification. The flexibility means that we can move wherever the income opportunities are. This is not a traditional portfolio that has a strategic asset allocation and it's always going to look like that over time. This is a portfolio that will move where the opportunities are and will move away from where we see the major risks of being. Diversification is crucial in an income portfolio, just as important, if not more important, than in a traditional balanced portfolio. We've all learned these lessons over time about diversification, but sometimes when we change our objective or mandate to something like income, we forget some of those diversification characteristics and why it is so important. So we continue to emphasize the importance of the diversification. That's geographic diversification, that's asset class diversification, and that's even looking across the capital structure. Thinking about things like preferreds, or close to Natalia's heart, convertible bonds. They provide different exposures across the capital structure that might better fit our risk-return profile. The feature of our approach is to leverage the breadth of our organization, leverage the expertise of our equity investors, our fixed income investors, our property investors. We rely on these specialists across the organization, people that we've worked with I've worked with for almost 2 decades, in trying to deliver solutions for our clients. It is an important relationship, and it is very much a partnership. We meet quarterly in a meeting that I chair. We base it in New York, but we video conference with London and Hong Kong, where we hear from each of the underlying portfolio managers. We hear about what they're seeing in the market, bottoms up. What are the high yield guys seeing as far as issuance patterns? What about leverage levels? And what other concerns they might have in the market? What are we seeing in emerging markets? What are we seeing in various equity areas? What are the types of tilts that our managers think will be compensated in markets? What are the risks they're seeing? This partnership allows us to have a dialogue back and forth. And not only do we just rely on them to manage their sleeve or their sub-portfolio, but we actually utilize their bottoms-up insights to come back into our asset allocation process. So we're forming top-down views across our solutions organization that really drive how we allocate. But it is informed by the insights that we're getting from all of these bottoms-up specialists. It's not that we just want to go off and look at our analytics top-down and make a decision. We want to leverage those insights combined with what our managers are seeing and put that together into an overall portfolio. So in recap of how we think about this, make risk an important portion of how you invest for income. Don't try and be the highest yielder. Think about where you get attractive trade-offs. Remember to be flexible and diversify your portfolios, and then leverage the different expertises that we have across the organization, which aren't even accessible to most individual investors. There aren't mutual funds that you can go and buy preferreds or buy non-agencies in the way that we can access them in our portfolio.
Ok, perfetto. E appena detto che il fondo, una delle caratteristiche principali del fondo è la flessibilità, quindi la possibilità che avete come gestori di spostarvi tra diverse aree dove poi trovate le opportunità migliori per generare income nel portafoglio. Se pensiamo al contesto in cui ci troviamo adesso, quali sono le aree in cui pensi che ci siano le migliori opportunità per un investitore che cerca income? E in generale qual è il tuo outlook a livello macroeconomico, come vedi i mercati nel medio periodo?
Yeah, very important in how we think about the world. So we've been in an environment where we have seen growth substantially improving really across the developed world and even in parts of the emerging world as well. And what's been very interesting about this period, and you can see on the slide we have up, this is really the first time that we're seeing coordinated global growth across the major developed regions at the same time since back in 2011. not going to spend a lot of time on this specific chart, but if you look at the lines showing the economic surprise, in a sense, what has been the result of the economic data that we've been seeing across these markets. And you can see them all improving and all on the positive side of the line. And at the same time, you can also see what's been happening to earnings revisions, global earnings revisions. And so you're seeing this positive environment, what we have referred to as more of a reflation environment, rather than what had previously just been that kind of slow growth, lower for longer. And we're seeing this again across the globe. The US had been one of the key drivers of this growth, but is now really passing the torch. And one of the most notable pieces of our economic outlook is that not only are we seeing that growth in the US now, but we're seeing it broaden out to the rest of the world. So when you think about our views in an improving growth environment, where we think that recession risk remains very, very low across the globe, is a pretty positive one for risk assets. And that really is one of the kind of the key themes that you'll see we reflect in our portfolio today. We see inflation rising back to more normal levels in most parts of the globe, and signs that, excuse me, that you might have some additional move away from kind of the monetary moves that have kind of driven the past few years to maybe a little bit more on the fiscal side. And we'll talk a little bit more about that, because that obviously remains a question, particularly in the US. But we see that to be quite a positive environment for global growth. So if we look a little more specifically at our outlook for income investing, it really leverages that key theme that I just spoke about. So this improving global growth environment that's broadening out to be more than just the US, but encompass Europe and Japan and other areas across the globe, is leading us to a positive risk outlook and a positive equity outlook. So this is going to tilt us to equity and away from fixed income and even away from credit. Now, credit's an important place to look at because we still find credit to be attractive. But when we think about the dimensions, we don't prefer credit to equity like we had in previous years. We still prefer credit, things like high yield and even emerging market debt, to government bonds in the developed world. But we now would rather take that risk through equity rather than through credit. So the preference for equity, but breadth across. We're not trying to differentiate as much different regions across the portfolio. So we like US equity. We like European equity. Japanese equity isn't as useful in an income context because we aren't able to deliver the same yields in Japan that we can in other parts of the globe, but we do have some exposure there. And emerging markets are able to deliver some attractive yields and would stand to benefit in this improved growth environment. So we are less trying to differentiate across the equity markets as we are trying to take broad equity risk and get broad yield across our equity portfolios.
Okay.
As I mentioned, on the credit side, you can see high yield remains a positive. But think about what I described as that is relative to government bonds and higher quality fixed income, not relative to equity. At the same time, we find our opportunistic allocations still to be diversifying and deliver some attractive yields in the portfolio. Preferreds, for example, remain an area where we're getting some of the most attractive yields in the portfolio, and we're doing it with an exposure to primarily financials, which we think can benefit from some of the rising rate pressure that we might see in the US, and potentially from improved regulation for financials in the US that we think may be more likely. Non-agency mortgages I talked about earlier, and emerging market debt, investment grade credit, all of these have roles to play in diversifying our risk. So we less see one standout asset that we want to dominate all of our risk, a tilt towards equity, and a comfort with taking risk across the portfolio, and general diversification across portfolios. The one last piece that I'll spend a moment on is our duration outlook. We do see interest rates likely moving higher. We see that pressure will build, not just from the Fed likely to raise rates, but the fact that we're seeing this improving global growth. And that is what leads us to think about managing some of our duration, managing our interest rate exposure, and keeping that offset. So when we buy the investment grade, which has longer duration, when we buy high yield, when we buy these types of asset classes, again, we are managing the duration in our portfolio.
Ok, grazie. E queste sono le tue view e mi chiedevo quali sono i rischi rispetto a queste view, cosa potrebbe andare non così come ti aspetti, quali sono le tue aspettative. Mi chiedevo come è posizionato il portafoglio nel caso le cose non andassero così come vi aspettate.
Yeah, that's a very important question. I'm sure it's on the minds of a lot of people. So there are obviously quite a few risks in this world, and I'm not sure that markets seem to really be focusing on those risks. Not the least of which, and I'm sure speaking to all of you in Europe, they're probably hit closer to home, but political risks. Obviously, the French election is coming up soon, and reading the papers, and I'm sure you're probably closer to this than we are, but reading the papers and seeing the discussion, it seems like that could be creating a lot of risks in markets, and I'm not sure how much risk markets are pricing in. We have been through this before. We've been through Brexit. We've been through a U.S. election. And markets have, with some maybe initial negative reaction, really recovered pretty quickly. So I'm not sure if markets, in a sense, can get somewhat complacent. But there obviously is a lot of political risk. Obviously, right here where I'm sitting, a lot of discussion about political risk in the U.S., a lot of question about what the Trump administration will be able to deliver. I mentioned earlier about the possibility of fiscal stimulus, playing a greater role in our outlook for the near term. And our outlook is not dependent on that fiscal stimulus. So even though maybe the odds have come down of a large infrastructure or fiscal package in the U.S., we think there is still some possibility there. But we think that markets have kind of slowed down a little bit and maybe are not necessarily counting on that or pricing that in. And we're seeing, the growth improvement even without the fiscal areas. So I think there's clearly a portion of political risk that we need to be aware of, that we need to think about. I mean, markets amazingly have continued to be at record low volatility levels. And I don't know about you guys, but it doesn't really feel to me like we should be at some of these record low volatility levels. So that always makes us a little concerned and makes us think about how we're positioned in the environment. But a topic that we spoke about a little bit earlier has been one that I get asked about a lot, and that's the risk of rising rates. And what does that mean, and how will that impact an income portfolio? And we've done a lot of work, a lot of analysis on this subject. And we did some analysis with the Global Income Fund because it's longer track record. And we did it also with our U.S. Income Builder Fund, which has actually the longest track record. And we looked at how these funds did in periods where the 10-year in the U.S. moved up sharply in a short period. So let's say more than 50 basis points in a short period. And we looked at each of these periods. We found that our funds tended to outperform a traditional index like the Barclays Bloomberg Aggregate Index, for example. And in the vast majority, virtually all of these environments, we were actually able to deliver a positive return. So you may ask, how is that possible in an income-oriented portfolio where the 10-year moves up so substantially? And the important question to ask yourself is, why are rates moving higher? And if interest rates are moving higher alongside improved growth, an improved economic outlook like we have been seeing, then that likely means that our risk assets, our equities, our credit exposure will be supporting the portfolio. Now, in our conservative portfolio, we obviously have a little less of that. So we need to think more closely about those duration exposures. And as I've talked about how we kind of manage those risks in the portfolio, we're constantly looking to leave ourselves with a portfolio that is not just going to be a one-way directional bet on the way that rates go. And the way that we're going to take our risk is looking at the overall environment rather than just picking one aspect of it. But if I did have to highlight one of the biggest risks to our income portfolios, it would be an environment where we get inflation and interest rates moving substantially higher, but not accompanied by that improved growth. If you think about what happened during the taper tantrum, where there were concern about growth, but at the same time rates moved meaningfully higher in a short period. Those types of environments are some of our biggest challenges. And we're going to watch that very closely, alongside watching the risk of a recession, particularly in the US. But what's important today is we do not see the probability of any of those events, either recession or stagflation, to be a high likelihood at all right now. And so we're going to continue to monitor these risks in the portfolio, but broadly position ourselves for the improving economic environment that we see today.
Ok, perfetto, penso sia molto chiaro. Non ci sono più domande da parte mia, ma volevo ringraziarti innanzitutto per questa prima parte dell'intervento. Penso che ci saranno domande dal pubblico, quindi aprirei il Q&A.
Direi che possiamo magari dedicare gli ultimi 8-9 minuti che abbiamo a domande da parte del pubblico. Da parte mia, mi accedo al microfono. Ecco, da parte mia volevo solo sottolineare un aspetto. Il carattere estremamente distintivo dei due comparti, il global income e il suo, come lo definisco io, fratello minore, perché in questo contesto noi abbiamo un team dedicato a New York che fa asset allocation, quindi che guarda il globo, guarda l'evoluzione, l'andamento delle economie, le problematiche e fa asset allocation, e poi abbiamo tanti team dedicati che fanno selezione all'interno delle singole asset class. Io amo sempre dire, ho la presunzione di dire che all'interno di questi comparti ci sia il meglio delle scelte income della banca, perché sono i responsabili delle singole parti del portafoglio a definire quali titoli mettere. Viceversa, nella stragrande maggioranza dei comparti sul mercato c'è un team che fa dall'asset allocation alla selezione titoli, è un unico team. Nel nostro caso invece il lavoro è molto differenziato e questo ci porta a raggiungere chiaramente un livello di eccellenza che è dimostrato dagli 8 anni e mezzo di storia del global income. Personalmente sono convinto che il conservative income, proprio in questo contesto, per i clienti che noi siamo abituati ad affrontare, possa avere prerogative di duplicare il grande successo del suo fratello maggiore, se non meglio, se non ancora di più. Se siamo pronti alle domande, prego. Un attimo che ti passano il microfono così possiamo tradurle per Michael.
Buonasera, volevo chiedere se questa strategia può essere può sostituire una strategia obbligazionaria tradizionale e come pensate magari di gestire eventuali drawdown che possono presentarsi sul mercato.
Grazie. Did you hear the? Okay.
Yeah, it's a very fair question. So obviously, by adding things like equity, other forms of credit, we're diversifying different risks. So if you're kind of starting in a bond fund, you might be lower risk overall than global income conservative, but your risks are going to be pretty concentrated. Obviously, you're going to be taking the interest rate risk as probably the dominant component of your bond portfolio. So even though your kind of overall standard deviation or risk level might move up a little bit to move to global income conservative, you will be moving from kind of a singular risk to a more diversified set of risks. Yes, there will be some equity, there will be some credit spread, and yes, there will also be some interest rate risk. So the important thing for a potential investor is to think about, is that risk level appropriate? But assuming that you are comfortable with that overall risk level, I think that the multi-asset aspect of our portfolio delivers a more holistic solution, a broader solution that captures different areas of investment and isn't just focused on one place in the market. So I do think it can be a substitute to the extent that investors are comfortable with the overall risk level.
What about the drawdown?
Yes. So drawdown is something that we think a lot about when investing for income. We know that income investors think it is very important to maintain their capital. And it's part of what our whole approach is, to really maintain that capital, to pay the large distribution, but to maintain that capital. So when we are thinking about our exposures and our risks, we're constantly thinking about that downside. So as I mentioned, we stress our portfolios, we look at various historical environments, and there is risk in this portfolio. There is equity risk, as I mentioned, there is credit risk. So we will move to some degree with the beta of markets, but we are constantly looking to balance those risk exposures and protect. And as we see the environment turning, we have multiple levers to use to manage that potential drawdown risk. So our asset allocation can obviously change. We can reduce our equity. We can hedge aspects of the portfolio. We could use equity futures. We could use treasury futures. And we can also work with our underlying partners to think about what risk we're taking in the underlying securities. So it is absolutely a core focus of ours to think about what the risks are, how do we prevent large drawdowns, but how do we deliver the overall income levels for our clients.
Direi che ci prendiamo un'altra domanda, magari, prego. Sì. Perché altrimenti poi andiamo fuori tempo massimo.
Sì, no, se posso. Buonasera. Volevo sapere soltanto qual è il vostro approccio sull'uso dei derivati e come usate questi strumenti sul portafoglio.
Ah, derivati.
Derivati.
Capito? Ok. Se utilizziamo derivati e come li usiamo?
It can be a very important and useful tool in managing a portfolio, but I want to emphasize how we use them. So this is not a complex derivatives-oriented portfolio where we're trying to put on alpha trades, where we're trying to capture different markets. We utilize derivatives to hedge risks in the portfolio. That is what we're doing. So if we think we're overexposed to equity risk, could we use a Euro Stoxx future or an S&P future to quickly mitigate some of the risk we have? We use the treasury futures. So think about our use of derivatives as a very efficient and quick risk management tool where we don't have to move all the underlying assets, but we can really efficiently change the risk profile of the portfolio. So many periods of time, I would expect to see no derivatives other than the kind of the currency hedges that are based in the portfolio. But the times that you're going to see us with derivatives are when we have a very specific risk that we want to hedge.
Beh, io direi che intanto chiuderei con un saluto e un ringraziamento a Natalia e a Michael in collegamento con noi. E nel chiudere vorrei invitarvi, nel materiale che vi è stato distribuito qui c'è l'altro argomento principale della nostra presenza al Salone, che è il lancio dei 3 model portfolio. Vi inviterei a venire al nostro stand per prendere materiale anche sul Global Income Conservative e magari per fare 2 chiacchiere con noi. Grazie a tutti e buon proseguimento. Arrivederci. Ciao Michael, grazie.
Bye. Bye Mike.
Good afternoon.
Grazie a voi.
Grazie, è stato facile all'inizio.
Sara non era fortissimo, però
L'audio di Mike
era un po', sì, però attenzione. Sì, infatti, lo sentivo.